The age-old question, is trading risky? To tell you the truth, yes, it is risky. Sometimes trading is something that people do on the side, and a lot of people might not be solely dependent on trading as their primary source of income. Why is it risky? Well, you can risk almost everything. You can risk a lot. You can lose almost everything. If you put $25,000 into your trading account, or if you put less than that, 100, 200, 1,000, 5,000, however much you put in, you can lose it if you don't understand a few principles. But let's see how much you can lose. So let's look at the chart right now. Let's say over here, last Thursday, we're looking at Tesla right now. If you got into a short over here, if you thought the market was going to go down, the market went from 224 to about 235, which is about $10. If you buy one share, yeah, that's about $10. And if you didn't get out at the right moment, then you would have lost that. Keep in mind, most people don't buy just one share unless they're practicing. Many people buy hundreds of shares, sometimes thousands, sometimes tens of thousands, even hundreds of thousands. And keep in mind that an option trade, one option is equal to 100 shares. So if you traded options and you held on to this with hopes that it was going to go up, by the end of the day, you could have lost $1,000. End of story. And when you woke up the next morning, it could have been even higher than that, taking into consideration the price over here. So, can you lose money? Of course you can lose money. So what separates the winners from the losers? What separates the people that actually do this successfully in comparison to the people that lose and give up? See, when you lose a trade, it's very easy to get discouraged and to stop. It happens all the time, and that's the main reason why the majority of people quit. They get discouraged. Instead of seeing it as a lesson, they rationalize that they are horrible at trading. They decide to give up, and they never want to look at the chart again. And then if a friend speaks to them about it, they say, oh yeah, I tried investing before, I lost this much money, I wouldn't do it. And then they wouldn't recommend it to other people. But let's say you did know what you were doing. Let's say that you were trading this setup right here. As you can see, we have our EMA here. Just gonna set that up. Oops. We just have our little simple EMA over here. Now, let's say you got into a short at you wanted to sell. You thought that the first candlestick of the day, with this, you thought that it was going to go down. You thought that entering right over here, because it broke this level right here, well, it almost hit that level, and keep in mind that usually it's a good idea to hold on and just to let it go past the low of the day in pre-market or wherever else before you enter or get into that short or long. Let's say you thought that it was going to go down. So you entered into a short over here. It broke this level right here. You got in over here. Then it turned around. So from 223, it hopped to 224, which is about, depending on how much you have, it could be a couple of cents, it could be $100, it could be $1,000, depending on how much you're invested. And some people might think that, oh, okay, like it's going up, but I think it's gonna turn around. So they let it hit this level. They either close out over here with a loss, gritting their teeth, maybe a little bit angry, maybe a little bit upset, and then the market turns around. And then it breaks below this level as well, so they might close out of that, which will lead to 2 losses. It happens all the time. And this could be a loss of $200, $300, $2,000, even more, even less. So they get out over here, and they might just stop trading for the day. They might stop trading for the day the moment they lost. They might think, I've already lost this much money. I do not want to risk anything. And if they did not do that, if they chose to enter market and to trade the market, say they got in over here above this level, passing our indicator right here, got into it, held on to it, maybe closed out and break even, got back into it, maybe get out again, or just held on to it. Some people don't like being in a negative drawdown at all, but it happens sometimes. So they, re-entry, and then if they held on to it, they would have been profitable. But when it comes to this, when it comes to getting out of trades at the right moment, that is what's going to determine your success. That, as well as being able to hold on to winning trades. Some people might get excited the moment they see a winner. They might trade this, they might get into a call, realize that it's going up, then see it going down, and then realize that it broke this level over here just a little bit. They might have got out of the trade. They might have waited for another re-entry. They might have re-entered right around here, only to see it go up and down. They might have exited. A lot of people are trading a lot instead of learning how to relax into the trade and trade out and trade at the right moments. But who can blame them? They want to trade. They want to not lose any money, so they close out quickly, which might cause them to re-enter trades over and over again. So a good time, a good moment, a good period where a trader can re-enter a trade is every time it breaks a previous high. Take this for example. Market goes up, goes down a little bit, goes up. Could assume that it would go down, but it didn't, and it broke the high right over here. Enter into this trade. As you can see, it goes straight up and then it goes back down. That is how the market is, and it requires time to understand. Sometimes you can also trade it with the EMA. Get into a trade over here, exit it over here, maybe a re-entry here, re-entry, re-entry, exit, re-entry, re-entry, re-entry. You have to watch the market during market hours or through a live replay just to see how price moves. Know when to enter and when to exit a trade. The more you know, the less risky it is. It is a calculated risk. There are some traders who have no idea what they're doing. They might look at a naked chart and just say, oh, I think the price is going to go up. I think the price is going to go down. And they could be right. But it would be a good idea to understand that risk, understand supply and demand levels, support and resistance, understand moving averages, understand different indicators, and then proceed with caution. And remember to close out of your losing trades instead of adding onto them in hopes that you will make up for those trades if it turns around. By that I mean some traders, let's go back to our first example over here. They might enter into a sell right around here, and then it goes down a little bit, and they think that it's going to turn around, or they think that it's going to continue to go down, but the price turns around, and they get in. The price goes up here, and let's see, it starts to go down. Instead of closing out here, some traders might think, oh, it's going to go back down since it broke our level here. They might add to a losing trade, It happens. So try to use as much common sense as possible. Try to get as basic as possible. Try to even watch somebody as they trade. We're gonna have our own service like that very soon, but you can do that. You can watch somebody as they trade, somebody who knows what they're doing. Sometimes you'll see how much they lose, and it might scare you, or it might just give you teach you a lesson into trading with an appropriate size. So for a beginner, I would recommend trading no more than one share, because trading one share will cause you to lose maybe a few dollars a day, but that's a lot better to pay a few dollars or $1, a couple of cents a day to learn how to trade live, in comparison to losing thousands or tens of thousands if you don't know what you're doing and you just want to go big. And I wouldn't recommend demo or paper trading as well, because it's not exactly accurate. You won't feel the same way. You won't feel the same way with pennies either, but it's very different. You can give it a shot if you don't believe me. You can demo trade for a week, and then you can live trade for a week, and you can tell me if you make it for a week, and then you can tell me if it's the same. And chances are it's not. So, to wrap up, is trading risky? Yes, it is. However, it is a calculated risk. And those who know how to calculate those risks are able to win and are able to be more profitable. So, take your time. Remember to learn. It is a risk, but just take it slow, trade one share, and slowly, incrementally move your way up so that you are profitable, and so that you can become a successful trader.